BlackRock moved $165 billion into private credit to escape regulated banks. That escape route is collapsing right now. January 2026, Capital Economics warns $2 trillion in shadow banking, redemption spiking, the exact signal before 2007. Leverage plus illiquidity quote rarely ends well when growth slows. Growth is slowing, AI bubble, rate hikes. If this infects the broader system, credit tightens, recession follows. Same path, subprime to Bear Stearns to Lehman to crisis. The irony, institutions built private credit to avoid regulations. Now, private credit is the vulnerability. If you hold bonds, stocks, credit market assets, you're exposed. This isn't prediction. This is pattern recognition. The pattern is executing now. So, what is private credit? Most people have never heard of it. By design, private credit is loans made by non-bank lenders. Private equity funds, hedge funds, asset managers, BlackRock, Apollo, KKR, Ares, Oaktree, they lend to companies that can't get traditional bank loans. Middle market firms, highly leveraged businesses, commercial real estate, leverage buyouts, borrowers who can't access public bonds or find bank lending too expensive after Basel III. Here's how we got here. 2008 financial crisis. Governments respond with Basel III. Make banks hold more capital against risky loans. Banks become safer, but risky lending becomes unprofitable. Capital requirements too high. Returns don't justify the risk. So banks pull back from leveraged companies, commercial real estate, middle market firms without pristine credit. But demand for credit doesn't disappear. Companies still need money. Real estate developers still need financing. Private equity still needs to fund buyouts. So the lending moves from regulated banks to private credit funds. Same loans, same borrowers, different lender. And here's the key: minimal oversight. Private credit funds don't face the same reporting or capital requirements as banks. They operate in what Capital Economics calls the shadowy part of the system, regulatory arbitrage moving activity to less regulated space. How big? Hard to know exactly. That's the problem. Estimates over 2 trillion globally, maybe more. Lack of transparency means nobody knows the precise number. The growth trajectory tells the story. 2010, 500 billion. 2020, 1.2, 2 trillion. 2025, over 2 trillion. Explosive pension funds, insurance companies, sovereign wealth funds looking for yield. Private credit promises 8, 10, 12% returns in a low-rate environment. Institutional money floods and the borrowers already leveraged companies 3, 4, 5 times debt to EBITDA. Their models work if the economy grows, rates stay low, everything goes according to plan. Commercial real estate, post-COVID office buildings not fully leased, retail, struggling hotels, mixed use and leverage buyouts. Private equity borrows to buy companies, loads them with debt from private credit funds, closed-loop PE firms, manage private credit funds, and borrow from them. Capital Economics, specific phrase, the shadowy part of the system, not conspiracy language. Mainstream research, 2 trillion operating with minimal supervision. The structure eerily similar to shadow banking in 2007. Back then, subprime mortgages and CDOS sold to investors who didn't understand the risk. Non-bank lenders originated and sold loans. When housing stopped rising, defaults spiked, structure collapsed, contagion to Bear Stearns, Lehman, AIG, global system, private credit, different asset, same structure. Loans outside traditional banking, leverage, opacity, minimal oversight, and now stress appearing. This isn't conspiracy. This is regulatory arbitrage at scale, worked beautifully for a decade until the system gets tested. That moment might be now. Now here's why the structure matters. Private credit funds have 3 features that when combined create what Capital Economics calls a situation that rarely ends well when growth slows. Feature 1, leverage. Feature 2, illiquidity. Feature 3, maturity mismatch. Let's break each one down. Leverage. Private credit funds don't just lend the money their investors give them. They borrow additional money to amplify returns. A fund raises $1 billion from investors. It borrows another $500 million from banks or other lenders. Now it has $1.5 billion to lend out. If the fund earns 10% on those loans, that's $150 million in interest income. After paying interest on the borrowed $500 million, the returns to the original $1 billion are amplified. Leverage works great on the way up. Every dollar of gain is magnified, but it works the same way on the way down. If borrowers start defaulting, the fund takes losses, and those losses are magnified by the leverage. A 10% loss on 1.5 billion is 150 million. But the fund only has 1 billion of investor capital. That's a 15% loss to investors. Leverage cuts both ways. Illiquidity, this is the bigger problem. Private credit loans are not traded on public markets. There's no bond market for these loans, no daily pricing, no liquidity. If a private credit fund needs cash, it can't just sell the loans. There's no buyer. The loans are held to maturity 5-year terms, 7-year terms, which is fine if everybody's happy and nobody wants their money back. But if investors start asking for redemptions, the fund has a problem. It can't sell the loans. It's stuck. So what does it do? It sells whatever it can sell. Maybe it holds some public bonds or stocks as a liquidity buffer. It sells those fire sale prices drop. Other funds holding the same assets see their portfolios marked down. More investors get nervous, more redemptions, more fire sales. Classic liquidity spiral, maturity mismatch. Private credit funds promise investors they can get their money back on a quarterly or annual basis. Redemption windows sounds reasonable, but the loans the fund makes are 5 to 7 year commitments. The fund is borrowing short and lending long, short-term liabilities, long-term assets. This is the same structure that causes bank runs. If more than a small percentage of investors want their money back at the same time, the fund can't meet the redemptions without selling assets at distressed prices. And here's what makes it worse. Private credit funds often include gates, clauses that let the fund limit or suspend redemptions if requests exceed a certain threshold, which sounds like a safety mechanism. But when a fund gates redemptions, it signals distress. And that signal causes more investors to try to get out before the gate slams shut. Self-fulfilling panic. Capital economics, their exact phrase, leverage plus illiquidity, rarely ends well when growth slows. That's not hyperbole. That's pattern recognition from financial history. This exact combination has blown up repeatedly. Hedge funds in 1998, long-term capital management, subprime mortgage vehicles in 2007, structured investment vehicles that couldn't roll over their commercial paper. Every time the pattern is the same, leverage amplifies losses, illiquidity prevents orderly exit. Maturity mismatch creates forced selling, prices collapse, contagion spreads, and right now, growth is slowing. AI bubble concerns, corporate earnings declining, interest rates still elevated even after cuts. The borrowers in private credit, they're the ones most vulnerable, highly leveraged, dependent on refinancing. If they can't refinance, they default. If defaults spike, funds take losses. If funds take losses, investors want out. If investors want out, funds face redemptions. They can't meet without fire sales. The mechanics are mathematical. This is not about predicting the future. This is about understanding the structure, and the structure is unstable. That's the structure. Now, what's happening right now? Capital Economics reports private credit funds experiencing redemption spike. Investors pulling money out. Early warning sign, canary in the coal mine. If you know history, you know how this plays out. Fourth quarter 2025, redemption requests increase significantly. Some funds gate redemptions, limit withdrawals. Few suspend entirely. Not widespread yet, but happening. Accelerating into January 2026, when Capital Economics publishes warning, timing matters. This is exactly how 2007 started. Timeline June 2007. 2 Bear Stearns hedge funds in subprime freeze redemptions. Facing losses can't meet redemptions without fire sales, so they gate. Media calls it isolated. August 2007. BNP Paribas freezes 3 funds exposed to subprime. Can't value assets. No market, no price. Narrative contained. Subprime small. Won't spread. September 2007, Northern Rock Bank run in UK. Relied on short-term funding. Markets froze. March 2008, Bear Stearns collapses. September 2008, Lehman bankruptcy. AIG bailout. Global crisis full contagion patterns start small isolated incidents, funds freezing redemptions, everyone says contained, then spreads not because initial problem massive, but structure interconnected. One fund's fire sale, another's mark to market loss, one default, another's counterparty risk network propagates shocks. Right now, early stage redemptions, rising gates going up, Capital Economics, sees it publishing warnings, does this stay contained or spread? Why it might spread? AI bubble concerns. Last 3 years, huge capital into AI. Startups, infrastructure, data centers, chips, valuations soared. Private credit lent heavily, high growth, high leverage. Logic. AI transformational companies grow into valuations. Loans safe. Now, narrative shifting. Questions about monetization, whether boom overblown. If AI companies miss targets, valuations drop. Refinancing weakens. Can't refinance. Default. Funds take losses, not just AI. Commercial real estate struggling post-COVID. Office occupancy down 20-30%. Landlords borrowed on pre-COVID valuations now underwater. Retail pressured. Hotels mixed use same. Leverage buyouts loaded with debt from 2020, 2021. Zero rate deals. Now rates higher. Refinancing expensive. Margins squeezed. Defaults ticking up. Capital economics phrase large enough or contagious enough to infect broader system. Threshold question. Private credit big enough to spill into banks, public markets, real economy. 2 trillion says yes. Structure says yes. Leverage liquidity, maturity mismatch. Formula for contagion, redemption spike, not the crisis. The warning signal, stress building, wait until obvious. Front page news. Repositioning done institutions, see spike, know what means acting. Now question is, are you now? Here's the irony that makes this whole situation even more significant. BlackRock, KK, the largest asset manager in the world, moved $165 billion into private credit over the last decade. Why? To escape the very risks they saw building in the regulated banking system. They built private credit as the solution, and now private credit itself is the problem. Let's understand the strategy. After 2008, after Basel III, BlackRock, CK, and other major asset managers, Apollo, KKR, Carlyle, Ares, they all saw the same thing. Regulated banks were going to be constrained. Higher capital requirements meant lower returns on lending. Banks would pull back from risky borrowers, but the demand for credit wouldn't disappear. Opportunity, become the lender, build private credit platforms, step into the gap left by banks. And it wasn't just about the lending opportunity. It was about regulatory arbitrage. Private credit funds face minimal oversight compared to banks. No Basel III capital requirements, no daily reporting to regulators. More flexibility, higher leverage, better returns. For BlackRock, this was strategic genius. They didn't trust the regulated banking system to deliver consistent returns in a post-crisis world. Too much oversight, too many constraints. So they built a parallel system outside the regulations and they sold it to investors as a way to get bond-like returns with equity-like upside. Institutional investors, pension funds, insurance companies, sovereign wealth funds, they piled in. Why hold treasury bonds yielding 2% when you can get private credit yielding 9 or 10% with supposedly similar risk? The pitch worked. Assets under management in private credit exploded. BlackRock, CK, went from almost nothing in private credit in 2010 to $165 billion by 2025. Markedly leading position. But here's what they built: a system with all the structural vulnerabilities we just described. Leverage, illiquidity, maturity mismatch. They built it because the returns were too attractive to ignore. And for over a decade, it worked. Default stayed low, the economy grew, interest rates stayed low, then normalized slowly. Everything went according to plan. Investors got their returns. BlackRock, CK collected management fees and performance fees. Everybody won until now. Now the vulnerabilities are being tested. Growth slowing, defaults rising, redemptions spiking. And BlackRock, CK, they're not stupid. They built this market. They understand the risks better than anyone. They know what leverage plus illiquidity means when redemptions spike. They know what happens when you can't sell assets to meet redemptions. They lived through 2008. They watched hedge funds blow up. They watched structured investment vehicles collapse. They know the playbook. So here's the question. If capital economics is publishing warnings about private credit stress, if redemptions are spiking, if the structure is unstable, what is BlackRock, CK doing? Are they sitting there holding $165 billion in an asset class that's showing signs of distress? Or are they quietly repositioning, reducing exposure, moving to safer assets, getting liquid? And here's the thing about being BlackRock. When you manage $9 trillion in total assets, you can move. You have options. You can shift allocations. You can sell. You can hedge. Retail investors don't have those options. If you're invested in a private credit fund through your pension or your insurance policy, you can't just sell. You're locked in. You're dependent on the fund manager to protect you. And if the fund gates redemptions, you're stuck. This is the pattern that repeats throughout financial history. Institutions build markets. They profit on the way up. They see the warning signs. They position defensively. And retail, the general public, pension holders, they are the last to know. By the time the crisis is obvious, the smart money has already exited. Left holding the bag becomes literal. BlackRock TK moving into private credit to escape bank risk only to create a new risk that might be larger and less transparent. That's not just irony, that's the cycle. Capital flows to where returns are highest and oversight is lowest. It works until it doesn't. And when it doesn't work, the people who built the system are the first ones out. The question is whether you see it in time. Private credit showing stress, redemption spiking, structure unstable. Why does this matter for broader economy? Why could this infect entire financial system? Because contagion doesn't stay contained, never does. Let's walk through the channels. Channel 1, direct bank exposure. Private credit funds don't operate in isolation. They borrow from banks. Remember the leverage? Funds raise money from investors, then borrow additional money to amplify returns. Where do they borrow? Banks. If a private credit fund defaults, the bank that lent to it takes a loss. How much exposure do banks have? Hard to know. Private credit operates with minimal disclosure, but we know banks are involved. Credit lines, leverage facilities. If funds start failing, banks take losses. Channel 2, collateral haircuts. Private credit loans are used as collateral for other financing. A fund pledges its loan portfolio to borrow money. If the value of those loans gets marked down, the lender demands more collateral or calls the loan margin call. The fund has to sell assets to meet the call. Fire sale. This is exactly what happened in 2008 with mortgage-backed securities. As subprime loans defaulted, MBS values dropped. Funds holding MBS faced margin calls. Forced selling, prices spiraled down. Same mechanics here. Channel 3, confidence crisis. If private credit blows up, investors lose trust in all credit. Doesn't matter if your bonds are safe, the market doesn't discriminate in a panic. Credit spreads widen. Borrowing costs spike for everyone. Companies that need to refinance debt face higher rates. Some can't refinance at all. They default. More defaults feed the crisis. Self-reinforcing cycle. Channel 4, institutional exposure. Who invests in private credit? Pension funds, insurance companies, university endowments. These institutions have obligations. Pensions pay retirees. Insurance companies pay claims. If they take losses in private credit, they have less capital. They reduce risk. They sell other assets. They stop making new investments. Economic activity contracts. And here's the feedback loop. If insurers and pensions pull back, companies can't get financing. Layoffs, more defaults, more stress on private credit loop tightens. Capital economics, their exact language. If problems large enough or contagious enough to infect broader financial system, credit tightens, generally recession follows. That's not speculation. That's the mechanism. Credit tightening means companies can't borrow. Can't borrow, can't invest. Can't invest, can't grow. Can't grow, they lay off workers. Workers lose income, they spend less. Spending drops, more companies struggle. Recession, compare this to 2007. Stage 1, subprime mortgages start defaulting. Shadow banking system, non-bank lenders. Stage 2, funds holding subprime securities take losses. Bear Stearns hedge funds freeze June 2007. BNP Paribas August narrative, it's contained. Subprime small. Stage 3, banks exposed to subprime take losses. Bear Stearns itself, March 2008. Stage 4, counterparty risk spreads. Nobody knows who's exposed. Trust breaks down, credit markets freeze. Lehman can't roll over short-term debt. Bankruptcy, September 2008. AIG bailout. Stage 5, full contagion. Global credit freeze. Recession, massive bailouts. The playbook is identical for private credit. Stage 1, borrowers default. Happening now. Highly leveraged companies, commercial real estate, AI bubble companies. Stage 2, funds take losses, face redemptions, gate withdrawals happening now. Stage 3, banks exposed, take losses. Coming next, we don't know how much exposure because reporting is minimal, but it exists. Stage 4, confidence crisis. Credit spreads blow out. Nobody trusts anything. Credit seizes. Stage 5, contagion to real economy. Companies can't refinance. Layoffs, defaults, recession. Are regulated banks better prepared than 2008? Yes, more capital, stress tests, better oversight, but that doesn't mean contagion can't happen. Contagion doesn't require bank failures, just requires credit tightening. And if private credit, $2 trillion, experiences fire sales and redemption gates, credit tightens. The mechanism is mathematical, not about confidence or sentiment, about structure. Capital economics sees it. They're calling it the shadowy part of the system for a reason. Outside regulatory view, large scale, leveraged, illiquid, and showing stress. The question isn't whether this can spread, the question is how far and how fast. And by the time you have the answer, the repositioning is already complete. Let's bring it all together. This is not prediction, this is pattern recognition. The same pattern that's played out repeatedly throughout financial history is playing out right now in private credit. The pattern shadow system builds outside regulatory oversight. Higher returns attract capital. Growth phase. Everybody wins. Leverage amplifies gains. Then growth slows. Cracks appear. Early stress signals. Redemptions. Gates. Most people ignore the signals. It's contained. It's isolated. Nothing to worry about. Then contagion. Fire sales. Confidence crisis. Credit freeze. By the time it's obvious the repositioning is done, the institutions that built the system have already exited. The population holds the losses. 2007 subprime mortgages, shadow banking, non-bank lenders, securitization vehicles, minimal oversight worked beautifully until housing stopped going up. Bear Stearns, June 2007. BNPA, August. Everyone said contained. Lehman, September 2008. AIG, global crisis. The people who saw it in June 2007 had 18 months to position. The people who waited until Lehman, too late. 2008, long-term capital management hedge fund, massive leverage derivatives. Russia defaulted. LTCM nearly brought down the system. Fed orchestrated bailout. The pattern. Leverage plus illiquidity plus shock equals cascade. Now private credit, $2 trillion, shadow banking, minimal oversight, leverage liquidity, maturity mismatch, capital economics warning, January 2026, redemption spiking, growth slowing, AI bubble concerns, rates still elevated, profits declining, the borrowers most at risk, highly leveraged companies, commercial real estate models that only work if everything goes right. Everything's not going right. The mechanics are identical. Defaults rise, funds take losses, investors want out, funds can't meet redemptions without fire sales, prices collapse, contagion spreads, banks take losses, credit tightens, recession follows. This is not speculation. This is structure. Structure determines outcome. So what do you do with this information? You understand that the machine is already in motion. You understand that by the time this becomes obvious to the mainstream, the repositioning will already be complete. Bloomberg runs headlines. Private credit crisis. Regulators hold hearings. Politicians demand answers, and the smart money is already positioned defensively. You position yourself accordingly. You understand that holding assets denominated in a debasing credit system is a choice to participate in the transfer mechanism. You understand that illiquid assets in a liquidity crisis are the worst place to be. You increase liquidity. You reduce exposure to highly leveraged borrowers, to commercial real estate, to sectors dependent on easy credit. You consider defensive assets that don't depend on credit markets functioning, gold, short duration bonds, cash equivalents, not because you're predicting collapse, because you're understanding structure. And you understand that the institutions that built private credit, BlackRock, CK, Apollo, KKR, they know all of this. They lived through 2008. They understand leverage and illiquidity. They see the redemption spike. If capital economics is publishing warnings, you can be certain the major asset managers are having internal discussions about exposure, liquidity, positioning. They have the ability to move. The question is whether you do. Unlike 2007, you have the opportunity to see the pattern while it's executing rather than understanding it only after the collapse. June 2007, the signals were there. Bear Stearns hedge funds freezing redemptions. Most ignored it, seemed distant, contained. 18 months later, Lehman, too late. Right now, January 2026, capital economics warning, redemptions spiking, private credit gates going up. The signals are here. The question is whether you see them. Subscribe now if you want to see how the pattern completes, what stage 4 looks like when it arrives. Hit like if this connected the dots for you. Comment below. Are you positioned defensively, or are you still holding illiquid assets in a system showing signs of stress? Because the pattern doesn't care whether you believe it. The pattern doesn't require your understanding. It simply executes. And right now, we're watching it execute in real time. The question is, what are you going to do about